Welcome to the Salty Investors, episode number 23. It is March 10th, 2023. How are you today, Tim? Beautiful March day.
Oh, yeah, a bit overcast, but yeah, it's pretty good. What about yourself?
Yeah, I don't know why I said that. It's the same here. It's overcast, bit humid, but anyway, we will struggle on. What is your salt for this week, Tim?
Oh, you might have noticed a few trains are having problems in Sydney, and a couple of people
I've
have
heard that.
spoken out about this company called Uber price gouging people. I'm like, wow,
Ah,
these people must know what they're talking about. And this guy called Carl Stefanovic, I don't know if you remember him, but
oh yeah,
yeah, he's
wanker.
just, yeah. Carl reckons he knows what he's talking about and done economics, and he's complaining about price gouging. And I thought, wow, what's this price gouging? And they've
Yep,
got this Uber have got price surging when there's high demand for their services. So what price surging does is when there's high demand,
yep,
encourages people to come and, start Uber, get on the road and help people out. That's what it does.
yep,
High prices encourages people, and it also, stops people who don't really need to use the service from using it. So,
yep.
but Carl's complaining that, instead of a $38 fare, it's now $300. So what pisses me off about Carl's, I'm like, it must be on at least $500,000 a year,
No, it's more than that.
is it?
Yeah, yeah,
And these people that are driving Ubers are on like, a couple of $100 a week, and they've one
yep,
chance in the year to get a few $100 extra in their pocket. Carl's
yeah.
jumping on them from a 1,000-story building, going, "Oh yeah, you can't earn an extra couple of $100, mate," And
Yep.
Carl up here in the Sunshine Coast has got a place with $8 million. Give me a call, Carl. Come on, let's go talk about it, mate. I want to learn a bit about economics, But
Dear.
what do you think
Well,
about it? Yeah.
that's just that's the nature of people opining on subjects that they haven't really thought through. I think that's hopefully we don't do too much of that here ourselves, but
Yeah.
I think it's just normal and natural that happens. Radio hosts or TV hosts, they have to cover a wide range of things. They can't be an expert on all of them, and actually they probably don't know much about any of them. They're going off gut instincts and stuff. Yeah, like you say, I mean, look, the whole point of that is that if there's a surge in demand, there's a response, and a pretty immediate one. So people, instead of sitting there on the couch saying, shit, I can go out and get $100 fare instead of it being, $25 or something. And so it's a response. And, if you're someone who takes Ubers, you can decide to take it or not,
And
I
if you
think
think it's
it's a much more efficient system than, say, having taxis pay 250,000 for a fucking license. I mean, that doesn't increase demand when there's a surge, does it?
and the poor taxi drivers, they get nothing out of that.
Yeah.
They get paid the same amount per hour, and yeah,
Yep.
just a bit rich from some of these people that are on huge salaries to start criticizing some of the poorest working people in society about,
Yeah.
isn't it, Carl? Price gouging, Channel 9 for the amount he's asking for his pay each year, surely.
Oh, I know. Yeah. Or is it just a case of supply and demand? They want
Yeah,
him, and he
they
can
would.
demand this kind of money. Yeah.
Or set up
Um,
your own Uber. If you don't like you reckon Uber's, Carl, set up your own thing, mate. Set
yeah.
up your own thing. And you reckon people are going to get off the couch and start helping people for an extra $2 an hour? Well, set it up if you think that's going to help. Go ahead. No, no,
Yeah.
no. I'm not going to do that, is he? So,
No, of course not.
what? What are you salty about?
I just thought it was kind of funny watching the Queensland government congratulate itself on building the 1,100 kilometre, $5 billion expanded copper string project that will be 100% government owned. And Palaszczuk announced that they put a down payment on that of $500 million from their coal royalties. So, there's a number of contradictions to get into there. But, I mean, Glencore actually pulled a coal mine last year, citing as one of the reasons that the Queensland government had decided to hike their royalty rates. And so you just wonder, like, for how long will you have this royalty train coming in if you ban new coal mines and phase them out? Are you going to be deriving that much in royalties from your so-called government, 100% government-owned, copper string project? Yeah, I'm going to go out on a limb and say probably not. It will happen in 10 years. They'll be, they won't have any money and they'll privatize it and sell it off. That's what'll happen.
Yeah. Offload it to mum and dad retailers. Yeah, I don't know.
Well, is this a contradiction or not, or is it just, this is the way it is?
Oh, it's the game they love playing. They talk bad about these industries and how evil they are, but no harm using their money to fund whatever they want to do. Surely you shouldn't be accepting blood money from coal miners. Surely, if you don't believe in them, just leave them alone. And fund it another way. No.
I don't have any problem with the government sort of negotiating higher royalties if that, good on that. They should be trying to get a good deal, governments. And of course, companies are going to come out and say, that's just not good for investors. Of course they are. They're going to say that because they're trying to negotiate the other way. But the problem with that royalty rise thing, I don't think any of the companies were like Glencore considering projects were actually consulted on it. It was just sort of sprung on them. And and it wasn't the main reason. It wasn't the only reason that they cited pulling that project. It was like probably going into a global downturn, maybe not the best time, and the government is upping their royalties. So,
but they also put a damper on capital. Like, if you can change the rules that quickly on royalties, how can any banks lend to you? How are they going to project how profitable you're going to be in the future? So all this ambiguity.
Oh, that doesn't matter because banks won't lend to you anyway if you're starting a new coal project. Some of them won't.
Well, they're definitely not when when you don't know what's going to happen. It can be changed on a dime. It just makes other countries more acceptable.
Yeah, but they're not. They're doing it on the basis of ESG. They're not funding new fossil fuel projects because they're idiots. But it's sort of cutting your nose off to spite your face. It's sort of biting the hand that feeds you, sort of thing.
Mm-hmm.
Anyway, let's move on from the salt. We've got a bit of macro stuff here to deal with. Obviously, our mate Phil, put up rates for the 10th time in a row, up to 3.6. There is all kinds of hand-wringing. My God, the cash rate's at 3.6. What shall we do? The long-term average, of course, is about 6, but at 3.6, everyone's going nuts.
Mm-hmm.
I just highlighted the last paragraph of the statement, which said the board expects further tightening of monetary policy. Last month, they said the board expects to further rate rises. So this is, in the people who study this stuff endlessly will say this is a softening of language. Some people are betting that there'll be a pause because, and there could be next month, but the previous month he said there'll be further rate rises. We've had one of those, so I'd suggest there's going to be at least one more. That doesn't mean they might pause. The futures market says it's got it sort of topping out at 4, and next month the increase, it's only about a 39% increase. So that might reflect the fact that they think they are going higher, but maybe they don't go next month. They wait a month, wait a couple of months for more data. Who knows? I sort of think if you're going to do it, just fucking do it now. Just go again. I mean, it's not like he's hiking 75 basis points per go. I mean, 25. You got to do it. You got to do it. I think Peter Costello said the other day, like if you're going to do this thing, you got to do it properly, which a lot of people just don't seem to want to accept. I think Alan Kohler's out today or yesterday saying that, it's a recession we didn't need to have. The RBA is plunging us into a recession. Maybe. I don't know. We'll wait and see. I keep thinking that recessions aren't like, we treat recessions like it's a plague or something. Like it's actually some good to come out of recessions because you get malinvestment gets cleared up. Bad investment in shitty projects that never should have happened. The worst part is, people lose their jobs. temporarily. They'll get them back. They always do. Some people lose their houses. Some people have lose their businesses. But recessions aren't the end of the world. I think that's the problem. Ever since we've had Keynesian sort of dominance, is that we're scared of these. We've got to do everything we can to prevent the economy ever going down. It's like these things are actually useful in the long run. Yeah. Anything to say about the rate rises, Tim? Are you shitting your pants there as watching your savings get a higher interest rate?
But yeah, as you can see, like they're thinking December this year they're going to be cutting again. I'm like, I think futures markets, I don't know, it's a bit out of whack there. I think unless something goes wrong, I can't see them cutting this year. Now I'm in that camp, but
I mean, to be fair, I mean, they got it peaking at 4.01 in October, and then by December it's 3.95. So that's 10 basis points. It's not. I would say that curve says they're not cutting at all. I mean, they're at 3.6 by August 24. So that implies the same level of interest rates we've got now.
Yep. Oh yeah.
More than a year out. So. Which is kind of what we've been saying, like, get used to this idea that interest rates are going to stay elevated at 3.6% compared to sort of what it's been for the last 10 years or so.
Yep.
Yeah. Thought this was interesting. Westpac Card Tracker Index. So that's credit card spending. As you can see, a notable pull. I just included a couple of paragraphs of commentary there. You can see the dotted line is the 2-week average. So it jumps around. You can see it jumps around a lot, right?
Yep.
And then the thick line is sort of smoothed out over a month. But if you look at, so it dropped in the second half of February. And while this leaves the index at a relatively high level, the growth pulse appears to be slowing significantly, with the quarterly momentum in nominal spending now getting close to stalling. And they add that stalled nominal spending implies outright declines in real inflation-adjusted terms. So, beware the nominal numbers as usual, because especially when we've got elevated inflation. Didn't used to matter that much when inflation was 2%, but as you did now.
Yeah, it's good to see some card data, but it's good to see that people are adjusting here a little bit, but have to see if it continues.
This was from Fred. That's the Fed's database there, and you can see look at the personal savings rate as debt climbs. I mean that is a really nasty looking chart, isn't it? The way that, I mean, should say that on the left hand side, it's a bit of a chart crime if you think about it, because they're obviously set to different. So that it really only represents an increase of about $180 billion in what's that pretty much last 2 years. So that's not terrible, but this, I mean, for me, the takeaway there is the personal savings rate. I mean, look at those spikes during COVID, and now we're back to levels that haven't been seen for. I don't know how far that back that goes, but savings have been tapped. Put it that way.
Yeah, no room for a rally there, a retail rally. It doesn't look like it. So I don't know where the next bear market rally is going to come from, because a fair few people have invested now. I don't know if they'll feel like going in for another rally, but we'll have to wait and see.
Along the lines of smart people agreeing with us. So this is just a complete exercise in my own bias. You know who David Svensson is? You've heard of David Svensson?
No.
Oh, okay. So he's in charge of Yale's what do you call them? Endowment, which is huge, and he's, I think, got a record of something like close to 20% returns for a long time.
Wow.
Per annum. Really excellent investor. His US stock exposure today is 2% compared.
Wow.
There's some comparisons. Don't have the 2015 number, but I'm sure you could get back and find it. So that's just a reflection of how expensive he thinks US stocks are. And if you look at like Hussman's work, that's what he says. Basically we're in this rarefied air of valuations, and unless you think that that's the new normal, the US stock market's pretty expensive still.
Well, I was watching Terry Smith this morning, and he's got 20 PE, and you know what the bonds are doing. So, like, what are you doing mucking around with this stuff? But even Terry's saying he's getting 3% free cash flow yield now, but that's still still pretty low
across his portfolio.
He's crossed his portfolio, so it's increased a little bit, but still, when you compare it against bonds, you're not earning enough here, really. So I don't. But he says, you can't switch strategies. There's nobody in the world who's, Buffett's probably the only person in the world who's actually successfully over multiple time periods, straddled that sort of thinking. No one else in the world has sort of managed it I've ever seen. I've never. Do you know anybody who can do this?
I mean,
effectively,
not really, because let's say you lock in at the peak of rates, and you lock in the best 6% yields or something on 10-year treasuries. Let's say it gets that high. Powell came out this week and sort of said we might have to go further than we thought. And so let's say it's a 10. But at the point that you get to that peak, that will be the time to switch back into equity. So you can't do that, right? I mean, if you holding to mature, on your bonds, unless you've got new money coming in to put that into equities, but you want to allocate to equities at that point, right?
Yes.
So you can't really do it anyway, right?
Yep.
Even if you could time it, because it's nonsense about cash on the sidelines. Like to put more money into equities, you've got to sell your bonds, right?
It's very hard to do when you're getting 6%. And it's risk free. You go, I'm going to go into something that's already been doing badly.
But the problem there is, I'm sitting in 6%, and then 2 years go by, and you go, I've just missed 12% returns in the equity market while getting my 6. Congratulations. Mm-hmm. Let's go on to the stock for the week, which is Edwards Lifesciences Corp. Where are they based? They're a US-based company?
Yeah. So I thought, this is Terry's latest. I thought, what's he doing here? What's it look like? So I thought, I'll have a quick bit of a gander at it. And and it's just one of these brilliant businesses that's always very expensive. And you're thinking, should I get involved in it? So I had a bit of a deeper dive in it this time. I thought, Terry's into it. I've definitely got to have a quick look at it. It's basically heart valve type business. So you're looking at something which people aren't going to be cheap on. Like, you go to a heart surgeon, they're not going to go, we can get you a different type of heart valve. It's 10% cheaper, but the reliability of it isn't, we don't know about it. You're not going to take that risk. You're not going to go, let's go have open heart surgery and we'll do it twice. Like, you're pretty much going to go, you're spending the money, you might as well, get the best you can in there. So it's split between, this business is about 65% of their business is in this heart valve type thing, about 17% in surgical, and about 16% clinical. So most of it is a pure play, basically. And I think that's what Terry likes about it. You're not mucking around with something that, it's in pharmaceuticals, in devices. And the thing I like about it, you look out 10 years. Are we going to be getting fatter and lazier and more heart surgeries? We're getting richer, yes. So I'm looking at, I can sort of understand this business a little bit. Where is it going in 10 years' time? And then you got to start looking at the moat, thinking, who's going to come in against this? Like, who's going to take these guys on? And you've got Medtronic, which is another fairly good business, and they own about another 40% of the market share. And then you've got Boston Scientific, which makes up the rest. But if you imagine you're on a board, even in some pharmaceutical company, and you go, oh, let's go take on these guys, you're not going to do that. Like it's decades and decades worth of research, and then the certifications are just insane. Like these guys have only just got CE certification in Europe. So
right.
That allows them to go into low risk patients. But, these things take decades to build. And the amount of science that goes into it. So you're not going to be, mucking around, going up against these guys.
Essentially, this is a three company industry by the sounds of what you just said.
Yeah. Well, duopoly, really, two 50%, 40s, and then one little up and coming, which is growing, which is nice, but I'd rather just stick with the brand name. You can imagine some surgeon, he's not going to go mucking around too much in this, I don't think.
I mean, what's the risk here? That comes a new technology that rather than, having valve replacement, they just say, we'll just stick a heart in instead. Brand new heart.
Yeah. But that's pretty wild. Like
not a transplant, like just an artificial one. I don't know.
Yeah, well, these guys have done pig valves and all that in the past, and and then you got biocoatings on them. So you got all these coatings. You can actually take people's cells and grow them up. Like you can imagine months ahead, and you can attach them to a device, and so there's less rejection. These guys are this is what they're investing in, and so Medtronic is normally the pacemaker company. And so they've got a little bit of knowledge about this area as well, and a bit of expertise, but they're focused on, pacemakers mainly and devices. So that's why I like this, is because they're not going to go reinvesting in, some crazy company which they know nothing about. They're just going to plow it back into. Look at the buybacks happen here. Like this. It's an expensive company, and they're still, throwing in money into buybacks, which is one of the problems. It is a very expensive company, plowing into buybacks, but they don't pay any dividend. Look at the interest coverage ratio; it's 90. How many companies do you look at that are 90?
So their debt, it's not a lot. 690 million debt, 8 billion in equity. Your cash flow, you got $1 billion in cash flow. So your cash flow, your debt's only half your cash flow from 1 year operating cash flow.
So when you understand all these things, it's a very resistant business. You got high return on capital, gross margins are off the charts. And I can't see the moat being eaten away here too much. Debt is less than half than 1 year's cash flow. Free cash flow. The only thing here is it's expensive. So it's just one of these things you can't just go in and out of, but. I could see myself holding this for 5 or 10 years. Like you said, you look out 10 years, are people going to still need heart valve replacements? And I'm pretty sure they are. So I just, you stick with the leader, proven track performer. I don't know. I think it's fairly low risk if you can get it at a decent price here.
Yeah. Well, you think aging populations everywhere as well. I mean, you've got that natural sort of incremental growth there, haven't you? And then, as you say, there's more and more jurisdictions that they can get into.
Yep. Asia's going to get richer. As Asia gets richer, there's more people that are going to want, these luxury type operations. So, it all looks pretty good. It's just, what sort of price are you prepared to pay for it? Like if you go back to the previous slide, you can see the price to free cash flow. It's still fairly high. It's in the 40s. So, it's not something that you really can. So you got 40 here, or 32 price to earnings ratio. So it's nothing. It's not like a cheap. It has come down, but you're not picking this up for a steal, are you? So
no, and it's one of those companies that's unlikely to get.
Yep.
It's like a CSL kind of thing. You just you always got to pay
Yeah.
somewhere between 30 and 40 times earnings for it. Although CSL's been pretty rough of late, hasn't it?
Yeah. But yeah, you just look at this return on invested capital. They're just solid 20s. Like,
yeah,
and that's what I'm trying to understand now. Instead of going for these 30 plus return on invested capital, that drops back down to 5 or 10, because they're buying stuff and investing in stuff they don't really understand. You can see these guys can just reinvest. And
there's gross margins nearly 80%, 30% operating. Yeah.
Yeah, buy for 22 and sell it for 100. Like, like there's not too many businesses that actually sell a product. That is really hard to duplicate. All these technology companies do that. But what are they going to be in 5 years? I can't look out 5 years. This is a company where you can look at 5 years and go, yeah, I'm pretty sure I know where this is going to be.
I guess the risk with something like this is that they come out with a new valve and turns out a bunch of people have complications and all of a sudden they have to pull it back, recall, whatever. It's pretty hard to recall a valve once it's in, isn't it? It's not like you can just, it's like Cochlear just had to recall, some of its hearing aids. You can't just send it back, like that.
So risky, like that's a risk, but when you've got somebody who's been going since 1958, I discount that a little bit. I think these guys know what they're doing. They will take incremental risk. That's the problem with a newcomer. They will take bigger risks, to take market share by price or innovation. These guys aren't going to do that. They're going to do incremental improvements to limit that risk. So I don't know. It seems like a winner to me, but it's just I'm too cheap. That's my problem. So.
The perennial problem. Both of us have that problem.
Yeah.
All right. I just want to add at the end something I found interesting. You and I have talked offline. I don't think we've talked. Maybe we've mentioned Xero before as one of these companies that I just don't understand how you pay what the market price is. Now that's become less the case because the stock did peak at $150 and is now about 85. So it's lost a good 40%. But the main problem with this is this company's been growing its revenues very well. Doesn't make any money. Still more expenses, it spends more than it actually makes, and that's not a problem in an environment where people don't care. What's happened recently? They just came out with a announcement yesterday. They're restructuring. They're sacking 700 to 800 people. They've said here we need to streamline and simplify our organizations. We'll adjust our operating base as we balance growth and profitability. So this I think this is I've been saying this for a long time. Like, this is the inevitable outcome of an era where it doesn't matter about profits, it doesn't matter about cash flow, going into an era where it does. And the rubber has to hit the road. How long these people aren't Amazon? Maybe Amazon is the exception, not the rule.
Yes.
And so, and also, I've read reports about how these people are wonderful stewards of capital and they invest really well. And well, down here, Xero acquired a lending platform, Waddle, and expects to incur a write-down of $30 to $40 million as a result of this decision. So this is a company that doesn't generate positive cash flow and has incinerated $30 to $40 million of investor capital. And somebody, I don't know if somebody lost their job over that, but they probably should. And so it just I don't know. I want to bring this up. I'm not trying to shit on them, but I'm just this era of revenue growth to the moon, forget about cash flow and profits. This is the comeuppance. We've got to pull it back now. I mean, I think the stock went up on this news, but I still don't know. I still can't get a valuation anywhere near the stock price at the moment. Other people can, but I mean, go ahead.
Yeah, Waddle's like an actual half decent business. It's just basically, you sell your invoices to them, and they give you a discount off it. But there's risk involved in that. Like, if you understand unsecured, creditors, Yeah, it doesn't always
Well,
pay
it's
back.
obviously the price they paid for it in 2020 was an elevated price. I mean, I remember this in 2000 when Computershare bought E-Trade, and then they had to write it down. They had to write down 75% of the cost because they just paid too much. They paid for it at the height of the .com boom, and they had to write it down. You know, it's bad. It happens, but it's just like, don't give me this, they're wonderful stewards of capital bullshit, because you wouldn't make those kind of mistakes.
Terry Smith just did a thing, and he said, Intuit, which was like the biggest, QuickBooks type company, they bought MailChimp, and they told him, oh, don't worry, half of the sale price, we might have paid double what it is, but half of it we're giving him in shares. Our shares, it's like, you don't tell a shareholder that. That's that's telling them straight away it's overvalued, and we're just diluting you to pay for this crap. It's like, oh, they just see it from their own point of view. They don't value capital, but maybe changing, like you said. So
maybe. Well, people have been forced, aren't they, to reevaluate. There is no alternative. Is now there is an alternative, and people have to be better with their capital allocation, because there are alternatives to sticking money into something and not getting a return for a decade, and thinking that's a good idea. All right. Well, maybe we'll leave it there, Tim. Thanks for the contribution this week. People can stick that one on their watch list. Another high-quality company, Edwards, and we'll see you next time.